If you want to be successful in trading, you need to be able to answer the question, I make money because. In this episode, we're going over the framework so that by the end of this, you'll know how and where to start. First off, I think there are four main ways to make money in trading. I'm going to go over each one. Pedmo, do you want to start with the most common and probably one of the main reasons we make money?
Yeah, sure. So the first one is what we focus most of our time on, and it's harvesting risk premium, right? We already talked a lot about this on these episodes and podcasts. And the main idea is that you are taking risks that other people don't want to take, right? For example, the simplest possible example is a buy and hold of S&P 500. The stock market is more risky than, like, for example, government bonds or other more stable, even though not risk free, but consider risk free assets. And so the investors in those types of market expect to get paid a higher premium for their risk, right? So that's a sort of idea of why something should make money trading. Another idea is, for example, other sources of premium that are already discovered, stuff that is very well known, like momentum in markets, is something that is very discussed over decades of research, but it has a lot of nuances and a lot of risks and volatility that a lot of the big players don't want to take on, or whatever reasons that you come up with, but it's there and it's effects that you can harvest, but they come up with that with those risks and those tails and stuff like that. So those are reasons why you get paid to do these sort of models, right? And so if you understand that, then you have an idea, okay, I get paid because I harvest risk premium, because I take risks others don't want to take, and I put capital in those markets to be used for whatever reason, and I get paid to do that. That's a reason to trade, right? It's not going to be, oh, I trade because it's at support, or because the open bar opened above, whatever signal you want. Those are just tools that you can use to harvest these type of effects once you model them out. But you need to understand why you are getting paid for your exposure.
100%. And also, like, I think it was from Scott or another person maybe on Twitter. I remember he was saying that a lot of risk premiums a long time ago used to be like alphas. So most of the time, it's an alpha that existed a while ago. So let's say, for example, Jim Simon's probably one of the most successful quants ever. He primarily sort of found trend following before most people because he actually had access to data, and they exploited a lot of that, at least in the early beginning area. And then obviously it became a lot more complicated. And now trend following for the most part is a wide phenomenon that you can do trend following in most markets and you can make a decent amount of return. But this does link to one other point. Do you want to kind of say the cons with each, let's say, like way to make money, and then we can go on to the next way and then kind of explain those cons and pros? What do you think?
For sure. Do you want to start with this one?
Yeah, because I was just about to jump into like the main reason this risk premiums exist and lost to exist. Because I always get this question of like, if everyone knows these exist, why are they not, arbitraged away? Why are they not, why can you make any money on them at all? And this one has a huge psychological barrier. Trend following, while it does make money in the long term, doesn't mean you're guaranteed to make money every day, every month, or even every year. And a famous trend following fund, Bill Dunn's, he beat the S&P, I think, for over a couple of decades, but still there were periods of times where he had underperformance or drawdowns that lasted more than a year. And while it's very easy to say that on this podcast, hey, you're going to be in a drawdown for a year, you're not going to make any money at all, you're going to be losing money that whole year. That is a very difficult thing to actually be able to go through and still have trust in your system and in your strategy. A lot of the times, and most people could probably relate to this listening to this podcast, is you'll experience a couple of losses. Maybe you'll have a week, maybe you'll have 2 weeks of losses, and then you'll start tinkering. You'll start changing the strategy because you saw that, oh, this loss was maybe caused by this X reason you think, and then that's why you change the strategy. And then all of a sudden, you're basically discretionary trading. You're trading tons of different strategies over the year, and you're never actually just sticking and having conviction in one. So that's probably one of the main barriers. And is there any other barriers you want to talk about?
Yeah, no, it's that. And if you think about, if all sophisticated players are all going through, like, are trying to find the highest risk adjusted returns to their clients, there comes a point, like if you think that everyone is playing at optimal, like trying to close every alpha source that they can find, it's really, how can I say, it's really hard to compete for the highest, like most most attractive sources of edges, right? Because everyone is looking for those. And what tends to happen and what seems to happen historically is that these sort of edges that are considered risk premium do get left out, and there's still some for us smaller players to collect some premium from those. Why do they remain open? I don't know. My guess is that is what I just said is funds are not the funds, and the most sophisticated players aren't necessarily so interested in that to the point that everyone closes those edges out completely. But you can see, even if that's not the case, you can see that historically, if you go back to the 80s and 90s and whatever, you can see that the return from those sources of premium has been decreasing over time. I think it was Rob Carver that released an article on that even recently, and he shows there like the risk-adjusted return of those sort of models over the years, and they do decrease. It's not like they are producing the same returns as when they were first discovered, like we were talking about. The risk premiums was once alpha, right? And as long as they are there, we can continue to collect them and collect them in more immature markets as well and stuff like that. But yeah, I guess that's the reason why they continue to exist.
Yeah, completely. And also, probably one of the most effective uses of them is deploying them on even more inefficient markets or newer markets, for example. A lot of the time, the risk premiums that have worked on equities now also work on crypto and have higher returns, or whatever new market maybe comes next. You can often apply the same sort of principles and logic, and they'll traditionally still work because a lot of them are also based on human behavior in some essence. So you can be able to exploit them in other markets. It does depend from market to market, but for the most part, it's at least worth sort of checking.
Yeah.
The second way to make money is you actually having pure alpha from superior models. So primarily what that looks like is actual inefficiencies. So this could be things such as doing arbitrage in some essence. This could be having better data that no one else is advanced to, for example. There's a lot of different ways you can have a superior model. For example, you can also have a black box in some essence. So you could have a way better machine learning model than anyone else. Now, I do get a bit frustrated with this point because I do see a lot of people on Twitter like to say, well, Jim Simons didn't understand how he made money. He famously said that a lot of the times the models are simply doing unintuitive things that they even thought would be wrong, but ultimately made money. And it's because they were getting signal from noise for the most part. Now, the big counterpoint of that is that 99.99999% of people are not going to be able to achieve building a black box model like that. Most of the people that are trying to build black box models are simply flashing in a simple machine learning algorithm and expecting it to go over the historical data and find actual signals. Most quant firms are competing at that sort of edge, so it's going to be very difficult for you to find pure inefficiencies, especially in a model-based system such as machine learning and things like that. So this wouldn't be what Pedmer and me talk about as like a low-hanging fruit. This isn't the easiest way to make money in trading. It's one of the hardest. Now, it can be one of the most profitable, but it is I don't know. It's harder than being like the number one basketball player or something like that. It is a very low probability that you're going to be able to achieve something like that.
Yeah, and and I find funny that argument too, because it's like you're really saying that first of all, you don't know if that's a psyop, right? The Medallion Fund is and the Jim Simons were always like very known for their secrecy. I also
Yeah.
saw him saying on other interviews that what they did was put a bunch of weak edges together into something that looked much better together, and also saw him talk about how they had so much data. They that one of their biggest spends was data. They spend tons and tons of cash on data, and they are not spending that money on open, high, low close like like retail is, right?
Yeah.
So do not compare. I think that's a fallacy to compare. Oh, because Jim Simons did these models, I can do them also. No, he was Jim Simons with the mathematical background that he had, with the practical background that he had, and with an army of PhDs in statistics and physics around him, right? So for the average retail to think that, oh, I'm going to go use this machine learning algorithm, I'm going to discover new patterns from data. In terms of alpha from superior models, that's a very competitive business to be in, and you do really need to have good knowledge around what you're doing. But yeah, you can have alpha from those superior models, but I would say that that's a hard edge that requires more competency on the trader. So I don't think it's for everyone. But yeah, it's a good goal to aspire to.
Correct. I'd also say if you are wanting to go down that path, it's a lot easier to do that in more inefficient or newer markets.
Yeah.
So if you are wanting to do that, nothing wrong with it. Just don't try and compete really in the equity space or like one of those. It's well, you can, but it's going to be a lot harder. So potentially go into newer markets, and often maybe you'll have a slightly easier time. But it is still one of the hardest ways, I'd say, in general to make money from trading. Also, you do bring up a very good point. I sometimes get this because I do like to write a decent amount about Jim Simons. I find him very inspirational. And also, a lot of the information he does give away, you have to be able to filter of what's going to be applicable and useful to you, right? Like when he talks about his black book models, I know that's not the way I'm going to be trading. It's not, I don't have the technical skill to even be able to compete at a, that sort of high level. And I've done some decent coding here and there, but for the most part, when he's talking about uncorrelated signals, that's more where I can somewhat compete in that essence and try and find those ways to diversify my portfolio, especially even if I am running, let's say, risk premiums. You can have somewhat uncorrelated strategies or low correlation strategies running together, and then you can build a way better diversified and better risk adjusted return portfolio kind of from that. But yeah, let's get into the next one. So do you want to go over the next one, Padma?
Yeah, so the next one is I have alpha from superior data or information. So you have access to a set of data or information that gives you an unfair advantage over your competitors, right? So, for example, this is already something that is known, right, for a very long time. But there was a fund, I don't know who I can tell you it is, but I read this interview where they were scanning like satellite data on parking lots, right? And so they could forecast clients' spend based on the parking lots, how much it was filled during the year, and they could almost forecast the earnings for the next earning cycle or whatever. That's access to information that at the time no one would have thought of and didn't have access to, and probably was super expensive to get. But that's superior information, right? So that's also why you could get paid for trading, because you have access to this information. For example, another one, I think it's a guy that had an agricultural business, and he was very much into like all the conferences, all the business owners, the top business owners on the agricultural space, and he was into all of this type of this network. He had a very deep connected network, and all that information that he had, he was very good at trading around those type of asset classes and other stuff, right? As long as it's not inside information. Of course, that's not what I'm saying. I'm saying that when you have a specific knowledge base, specific access to information that others don't, that is legal, and you have that to yourself, okay, now you can make better decisions that give you alpha that others don't have access to.
Yeah, completely. And I also think we're seeing the biggest version of this in poly markets, right? It is littered with insider trading or information maybe that you've gotten from other aspects or ways that you can actually beat the odds on something. So technically, like one example of this, right, was a very recent example of the guy that I believe, if I'm not wrong, I don't know if my memory is messing me up here, but it was like a blue dildo or something being thrown on the women's NBA courts.
Oh yeah, yeah.
And like that was a bet, right, where he had obviously put it very high on a particular color, and then he made it happen. In some essence, that's superior data and information, right? Like in a very crude way, that is a way that you can exploit that and make money off it. And like there's no prosecution or anything like that. I think he got in trouble. Like I think he spent like a day in jail because he threw the dildo on the court. But apart from that, like he could still make money on the actual bet itself. So that's a very crude version of it. But there are obviously many different ways you can make money on information and superior data.
Yeah, even for example, on chain, for example, on Hyperliquid or whatever, you have access to a bunch of wallets and people doing all sorts of stuff. Like, for example, you could have there's prior to October 10th, like the big crash in crypto, there was this big whale like shorting almost $1 billion worth of Bitcoin in it. And yeah, that's public information, like everybody was tracking them. But if you go down the scale and you notice some people doing some weird stuff sometimes, and you know that information, and you have some like model estimates around what those people are doing, if they are like trading they are being forced to trade, like in liquidations, or they're actually very good traders, and you can follow them. If you have access to that information and on a consistent basis, and you can detect patterns in that data, that's another source of information that many people might not have. So
Yeah, completely. I think that's actually a future podcast episode where we'll go over someone that did like arbitrage and he made like a 5 million, right?
I don't remember how much he made, but it was a lot of money. Yeah.
Yeah, it was a decent amount. So like those are great kind of things that we can also discuss on another one. And then the last one is I have superior access to cost slash rebates. Now this one sounds super boring, but it is actually I wouldn't say it's the most superior one, but it is a very good one to have, to be honest.
Yeah.
And this is basically the difference of how much it's costing you to take a trade primarily. So whether you have rebates on those orders or you just have lower commissions on them because you've traded such high volume, or if you're a fund, you often get lower costs as well on those side of things because you're anticipated to have a lot more volume. So those sort of things can save you one with traditional strategies. Even if you're just running a normal strategy, it will just be more profitable because you are basically handed back free money with lower commissions, right? So if you have a standard profitable strategy, you will make more money because of those lower commissions. Two, some strategies that wouldn't be profitable because costs are too high are now profitable. So you have that advantage as well. And then lastly, if you're doing anything market making or anything like that, you're often able to make more money because your costs are lower. So across the board, this is basically like getting a perk. You're basically getting a level up where anything you do, as long as it primarily does make sense of making money, now makes more money because you have lower costs.
Yeah, and we will talk about this one, but I saw an article about a guy that was explaining how they made money, like doing arbitrage on Hyperliquid between the Hypercore, so the trading platform and the Hyper EVM, the chain. And one of the interesting things is that over time he noticed that he had a competitor doing what he was doing. Like his margins were not that great, but they were fine to make money. And he noticed that two competitors entered the same type of trade that he was doing at the time. But there was one thing that the competitor didn't have, and it was access to a bunch of hype that he staked. And then by staking, he got a very large discount on. You get a very large discount on the trading fees. And so suddenly his margins were so much higher that he could actually tighten up his quotes or whatever to get lower margins. But since his rebate, the costs were so much smaller, he could afford that quote unquote loss compared to the competitors and still make money. And so he took the competitors out of his edge just because he had like an advantage in costs. So that's
Pretty
another
amazing.
reason.
Yeah.
Yeah.
It is one of the best perks you could get really in trading. And one thing that just came to me because I remember I wrote a thread on it a very long time ago was on the superior data and information when you were saying satellite images. That was I think Citadel on Walmart and they were prediction
Mhm.
like earnings and they did very well on that for quite a while. Now I think a lot of funds use satellite imagery, but like that sort of still thing kind of stays the same. Um,
Yeah, before like when no one knew about it, like before it was very innovative. Like going to the data and start like forecasting consumer sales because they know how many cars are in the driveway. That's information like when it started off, no one knew. It's like that's alpha, you
Yeah,
know?
exactly. Now the next part of this is a lot of these ways, are able to make you money in trading, but why and how can you maintain making that money? And often there has to be a reason behind it. So we're gonna go through a couple of the reasons. By the way, because we haven't shouted him out yet. This is created by Systematic Long Short, and he pretty much put this list together in a really nice, concise sort of tweet. And Pedmo and me obviously have already known these sort of things, but I thought it was a great conversation to kind of have. And I'll link his Twitter below if you want to follow. He occasionally does really good posts. But yeah, so the first way you can maintain your money or sustain your moat, for example, is by having fat tails. So primarily what this is that an easy example for this is like mean reversion. So on a mean reversion strategy, if you're betting on things reverting to the mean, a lot of the times you can keep on adding to that position, especially for example like small cap stocks and shorting them, and let's say 70% of the time, 80% of the time, you're going to be fine. You're going to be able to keep on adding to it. It will revert to the mean. You'll be able to make profit on that. But then 10% of the time, maybe even 1% of the time, 5% of the time, you will get a stock that just continues moving higher until you have no more, buying power or no more locates to continue shorting it, etc. And it will ultimately blow up your account. So it's a fat tail in that essence. You also have it on the opposite side, and that's definitely what Pedmer likes to exploit is on trend following sort of models. On trend following, you're going to be losing a lot, but a small amount each time, ideally. And then you'll have one particular play pay off for 100 trades or 20 trades, etc. It'll be 20R, 5R, etc. And that's because it is a trade that is continued momentum for a longer period of time. And the big thing around trend following is trying to maintain that winner for as long as possible. That's normally going to be the winner that makes you the most money out of everything else. So the main strategy or characteristic of a trend following model is you want to hold those winners for as long as possible. Anything you want to add?
That pretty much sums it up. It's like you have a normal distribution of returns. Everyone would love to have that, right? Everyone would love to have like something that you can reasonably like expect or forecast, whatever. But the truth is that real life has tails, and these models also have tails, right? So some models lose a lot of money quick, but make money consistently every day. But sometimes, like you said, on small caps, sometimes you get taken out of the game if you're not careful, if you do not manage the risks appropriately. And other models lose small amounts of money each day, like it's most of the time you're losing money, like trend following, but you have a very long tail that sometimes you hit these really large trades. And both of those types of models can suck in their own ways, and why so many people cannot adhere to them, why funds not necessarily like exploit them to the maximum capacity, why smarter competitors also stay out of those edges and go for the very top ones. And so that's why you keep your money, you keep your edge, whatever, because someone else is not willing to take that risk, hence the risk premium.
Yeah, completely. Do you want to do the next one, or should I go for it?
I'll go for it.
All right. So for the infrastructural barrier, that's kind of the next one. So first was fat tails, why you're keeping your money, and now this one is for infrastructure. This one can be pretty simply explained. This is where if you have necessarily code or speeds, so like speeds to the exchange, for example, the classic example is obviously market making on the US markets where they set up I think it was fiber wires or something. I can't remember the technical name, but they had very fast speeds of execution to the exchange, and they could beat pretty much everyone, so that they could beat them on market making and basically get paid between the bid and the ask, simply put. So there's a lot of those sort of things going on, and that's normally where most retail traders aren't going to be able to compete for the most part. As we kind of said before, if you do want to compete in the space, it's normally going to be in newer markets or more inefficient markets where you can have somewhat of an advantage if you're willing to create better code, or you have the maybe costs to do better servers, all those sort of things where you can exploit something like that. There are niche ones as well where this is more prevalent, I would say, in crypto, where maybe a particular token or contract has an issue that you can kind of exploit, and it is more infrastructurally barrier in the sense that it's very small amount of people are going to be able to understand how to exploit that. I can't think of a great example off the top of my head. Can you think of any, Pedma?
For example, if you have arbitrages between chains or something, a dead chain that has very low volume, and for example, a chain that has more volume, and the dead chain still has activity there, but it's very discounted to another chain. You can build reasonably simple yet simple code and capture that, where on another market you couldn't do that with simple code, and you would have to be much faster, and the same amount of margins would not be there. And it doesn't here. It's not that it is easy. I'm not trying to say that. I'm just saying that there's more opportunities for that if you are willing to bear the risk of going to those chains and have capital stuck in there.
Yeah, exactly. I'd also say, ironically, somewhat linked to the infrastructure one is normally you are having, in some essence, like a fat tail risk because a lot of times those newer exchanges, they're less stable, they're less reliable. There could be situations where your orders don't get executed, all those sort of things. You are taking on some risks on that side of things.
Totally.
Um, the next one is having a knowledge barrier. If you want to sort of explain this one, Pedmo?
Yeah, sure. So basically, the knowledge barrier would be it's just basically having bit better knowledge than the next average participant, right? Like you understand risk premiums. Not only that, you understand how to better harvest them. For example, instead of just using basic models, you go a step forward and you start using some volatility metrics. You start using some continuous model signals so that the way that you extract these returns are mostly are more close to optimal, in a optimal way to extract them. So you have some knowledge that you have. For example, on another example is smart contract knowledge, right? If you have an advantage of other people because you know how to read smart contracts and you can understand the risks, you can understand the pitfalls, maybe even inform projects of those problems that may occur in those smart contracts, stuff like that. Those are all things that other people don't have and that you have and that you can take advantage of.
Yeah, I would say like simply put as a real life example, it's one of those examples where let's say you can create sushi better than everyone else because you have better knowledge of how fish works, how to create sushi, all those sort of things, right? Like it's basically any expertise knowledge that you can take advantage of because the median person does not understand these things. And
Exactly.
that's basically how you can do it. The next
That's
one, oh sorry.
no, I was just going to say that's a very good way to put it. Like a mechanic that is the best mechanic in town and knows everything about whatever model car you.
The next one is a psychological barrier. We sort of already covered this, so I'll kind of go. I'll very quickly go over it. But primarily, this is where holding the strategy or dealing with anything around the strategy is very difficult mentally. So you'll have long drawdowns or abrupt losses or things like that, which traditional participants are going to stop using the strategy once that happens, or won't even trade it because of that X thing. It can also, like very side point, this also can be somewhat linked to like funds don't want to use it because they have to worry about investors leaving them. That's technically still like a mindset sort of thing or career sort of thing in like industry. So you can still exploit those because you're not having to bear, investors' money, stuff like that. The next one is opportunistic or special situations. This one I'm going to say I don't know the most about. This is mostly where there's a rare scenario where you can make money and you know some information around it, or it's overall a scenario that's maybe been very highly overreacted to. The only example I can really think of right now is the jelly trade that we did
Yeah,
ages ago.
I was going to say
Yeah,
that.
that's pretty much the only trade I could really think of off the top of my head, which is very special. It comes around once in a while. You can't really backtest for it. You can't predict for it. But when it does happen, if you can spot it and you have the knowledge also with it, then you can exploit it quite well. If you want, do you want to give like a 10-second, 20-second reminder of what the jelly trade was?
Yeah, so an exchange was cornered because some bad participant cornered them. I'm not going to go into the details. And with this coin called Jolly Jelly, so the protocol was forced to accumulate the entire market cap of that coin, and the protocol had bad debt, so it couldn't leave that short. What happened was the manipulator got into the spot market, started pumping the coin, and this protocol was stuck with a $15 million short on a coin that was worth $12 million. So they were cornered. We joined them on the long, on the spot side to try and make some money there. That's very opportunistic. You see something that someone is forced to do, and you are there. You understand it, and you take the directional action in the other side to then facilitate the liquidity of that person.
Yeah, completely. And then the last one is I have a structural barrier to entry, so primarily unfair access. I've got a really easy example from this. This was back in the small cap days. Back then, there were particular prop shops and also, I assume, funds, but most funds weren't trading it, that had access to locates earlier before everyone else. And that provided them with one main benefit. They could get locates for shares to short at a cheaper rate compared to everyone else, and often they had shares on stocks that ultimately would run out of locates. The traditional participant wouldn't be able to even short that stock anyway. So those sort of things is where, whether because you're in the industry or for whatever X reason, you have an unfair advantage compared to everyone else, and it has to be something like structural. So whether your brokerage or your exchange or the data you have, something like that, that most people do not have, and then you can exploit that basically on everyone else.
Yeah, agreed. So I don't think I have a better example than that.
Yeah, same. Some of these are very rare, like like examples because they don't happen that often, right? So that's why most of the time Pedmer and me are exploiting, risk premiums, and they're kind of our foundation for our portfolio. And then from there, when these other, examples of ways to make money in trading exist or show themselves, then we can exploit them when they're there. But for the most part, trying to find something where you have superior data slash information on 24/7 for the whole year is very, very difficult. Most of the time, even when you do have superior data slash information, it will be for a very limited amount of time. And that's why, a lot of us, well, sorry, Penmer and me primarily on this podcast talk about harvesting risk premiums and building traditional models like trend following and mean reversion, because that's something you can go away today and actually do. Whereas these other ones you can prepare for, you can learn about them, which is amazing. Because when they, present, then you can, but they're not going to be there tomorrow for you to, do something straight away.
Yeah, completely agree.